Welcome to the Predictive Playbook. We're going to talk the Forex markets, which has been one of my favorite markets in all the world. I don't know which one I like better, the sports betting markets or the Forex, but believe me, they have some of the same process and the same type of analysis for each one. So welcome to the show, Steve. We're going to do quick hitting segments here so people can stream it, in your backyard while you're playing fetch with your dog or picking up your case of beer or picking up takeout food. You can grab this information, which will be packed with a ton of information over a 5 to 10 minute period. So welcome to the show, Steve.
Yeah, great to be here, John. And it's funny, people don't think about the Forex markets. Only the professionals seem to, but it's the biggest, most liquid markets in the world, and they're basically 24/7 nonstop. So it's really incredible, and and people can trade them now very cheap as well. The cost, the cost per turn and stuff is much less. There's future contracts for these as well, but they're very liquid, heaviest volume, so they're great for everyone. Trading and technicals for you and me, of course, work very well in the Forex markets also.
Yeah, and as you can see on the chart here, I put up these are the cash Forex markets. So the upper left-hand corner there is the euro versus the dollar. Middle upper row is the Aussie versus the dollar. Upper right is the dollar yen. Lower left is the British pound. Then we have the euro yen cross in the middle there, 129.41. And the pound yen, 151.72. So the two that I mentioned last actually are pretty good plays when you're playing interest rates and also crude oil, which on our previous show we mentioned that we're really leaning toward the short side and probably will establish a position in that later today before the close, which brings into question these euro yen opportunities and the pound yen opportunity because when crude oil goes down, it impacts the commodity-based countries. And Japan is one that imports 100% of their crude oil, so they are the example of a country's macroeconomics that has no ability to bring out resources from their country. They have to bring in everything imported, no matter what. So when that goes down, that actually will increase the value of the yen, and it decreases the value relative to the euro and relative to the pound. So on those two markets, we're looking for net short positions, but we're going to focus on the Aussie, and I'm going to pull up the chart on the Aussie right now. And this is actually the euro. So now we just type in this, and there we go. There's the Aussie. So as you can see on the bottom, this is one of our positions, Steve. And between the two that we have on the books right now for 1 week, we're chugging along. We're heading in the right direction. But we're long 73.90, and we're currently at 73.89. So we're at a break even. But if I highlight the last couple of days here, I like this pattern here. This is a major engulfing candle with a hammer. And an engulfing candle takes out the previous day's high, the previous day's low, finishes higher than the opening. So if it's a green candle, that for those that haven't followed candles, and these are Japanese candlesticks, the close then is lower. I'm sorry, the close is higher than the opening when it's green, and when it's red, it's the direct opposite. So let's see. We had, a lot of little hammers, even you can say that these are almost dojis in many cases. Here's another positive hammer. We have this downdraft, which was related to the COVID, but it's not the deviant, it's the, what is it, Steve? The hybrid, the Delta variant. That's what I'm looking for. But now we have these two bullish candles, and I think the trend is going to be up this way. So, before I would add to this position, I need to know if you're on board with this.
Yeah, I've been short the Aussie here for a while, and it's been right under my trend following trigger mechanism, whatever you want to call it. But it's very close to breaking to the long side here. So once again, I think I look at everything from a risk reward perspective. The only way I'd be looking is to get into a long position here over the next couple months. So I mean, within the next couple of days, meaning for the next couple of months, I'd want to be long. So I think we'll get that buy indicator in the next couple of days. And it looks like those last 3 or 4, I mean, we have a pretty good breakout spot, it looks like here, because if you look, those 4 reds about 2 weeks ago, pretty quick breakdowns. You had a channel before that, and it broke through, boom, 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 and it's tried to kind of break back up to it, and we almost have had a 50% retracement over the last 2 weeks or so. I think if it breaks above the high from those 3-4 days ago last week, which basically I'm looking now is like 0.741, 0.738, so basically 0.74 on the Forex market at least. If it breaks above those tops, which is very close to do it, I think that's a good buy breakout indicator, and it's also going to break that trend line which you're drawing right now. I love it. I mean, look at that. What I like to look for, as you guys know, is multiple indicators on different time frames, weekly, monthly charts, and a daily, if they all have the same support levels. Something we haven't talked a lot about, but support resistance and then a trend line also is a great doubleheader there. And basically, it's going to break above the ceiling there, and it's going to break the trend line at the same time. So I think there's a lot of good buys, and you set your stop loss right below the lows there. So once again, tremendous risk-reward ratio, because this is at a multi-year low, basically. The only time it's been lower ever, really, and from looking at the charts, was in 2009 in the financial crash, and in April of 20, as you said, in the initial COVID crash. Otherwise, we're really at record lows. So risk-reward to the upside makes a lot of sense to me.
And with the, I don't want to draw politics into this, but with the fiscal stimulus still going on and the increase in the debt, it only makes sense that these currencies are going to go higher, dollar lower, because eventually inflation is going to really rear its ugly head. You can't keep spending at the rate that we are and not have to pay the piper at some point.
No, I totally agree. I mean, I don't think there's anything political about it. We've been printing money. We've been spending money and printing money like drunk sailors. I mean, it's the only way to put it. And I mean, the stimulus rounds of checks, and there's been more money pushed in the financial markets, the futures market, the commodity markets have soared. We've talked about lumber. It's been up and down, but we've talked about all commodities in general soaring. And that's a great point you bring up, John, because you're basically trading one currency for another. And I sure in the world do not want to be messing with dollars anytime soon, because I think they have inflation written all over them. And Australia is a country that's kind of had their act together for decades now. New Zealand and Australia, I think, have been two of the best, most free countries out there. So it makes a lot of sense to do the Aussie, a good currency against a currency that's just getting inflated and diluted, in my opinion, in the U.S. dollar.
Yep, good stuff. So thanks for your time, as always, Steve. We're going to be doing more quick hitters here as trading opportunities present themselves. It could be soybeans, it could be crude oil, it could be S&P 500. It might be Endeavor, which is the UFC stock that went public about 2 months ago. So tune in to the Predictive Playbook. We're going to create a special channel just for these financial shows. And you'll see that there's not much difference really conceptually between sports betting markets and what we're talking about right here. So on behalf of Steve, myself, the Predictive Playbook, WagerTalk.com, and SportsMemo.com, may all the trades be yours. This is